Welcome to Be the Boss of Your Money. We're going to say Be the Boss Special Edition. Today, on an intraday basis, the NASDAQ had a 10% correction. So we have a 10% correction on the NASDAQ. Didn't finish at its low. So we had a little bit of a bounce off the lows. At one point, the Dow was down over 700 points, finishing the day down about 350 points. That's not the point. The point is today going to be known as the day that we acknowledge that the bubble burst, that valuations were just too high and couldn't be sustained without rates remaining at or near zero? We have a lot to talk about. We're going to get into this, so let's roll the intro. And I'm going to make sure that we take stock of what happened, assess the damage, and see what we need to do going from. Thank you so much for joining me. My name is Mitch Goldberg. I am a financial advisor. I have over 3 decades of experience, the whole time dealing exclusively with retail clients. That means you. And I want to share a few things, a lot of things that could help make you better off financially down the road. We talk about investing, personal finance. We talk about the good days, the down days. We put it all in perspective right here. I break down the biggest news stories. We get into personal finance. We get into it all. But the idea is to take something away. I don't get overly giddy, overly excited on a big up day. And I don't get overly negative or down on a big down day. It's just another day. And we need to expect days like this. We need to expect volatility. Look, when the market's going up, nobody calls it volatility. It's only when the market's going down that we call it volatility. It's like, was it a down day? No. It was just a volatility kind of day. Okay, sure. It's a down day. Let's figure out what happened. Did something actually break? To me, it does have the feeling that we are hitting more than a very mild correction. It could reverse, of course. This is what we spoke about yesterday. It's all about interest rates. We can't blame the economy for being weak. If anything, it looks like the economy might be a little too strong. About a couple of days, on Monday, just Monday, it's only Thursday. On Monday, I was talking about a Goldilocks economy, an economy that's not too cold, not too weak, not too hot, an economy just right, where the Federal Reserve could just stay its course of accommodation, and we would just have this rotation that we expect from the work from home, stay at home tech cohort into the economy reopening cohort. But on a day like today, almost nothing worked except for energy stocks. And I'll tell you why in a moment. So let's just say, if you're out there watching this live, if you have any questions, ask me in the comments. I'd love to hear from you. If you have words of wisdom that you want to share, words of encouragement, those are always welcome as well. We'll make it a kind world. If you're watching this in the replay, I'd like to welcome you as well. Thank you so much for joining me. It means a lot to me. Your time is valuable, and the fact that you chose to spend some of it with me is a very big deal to me. So replay, live, questions, comments, hit me up. That's the best part of this. I already see somebody out there. We see Ron. Tesla down 33% from its high in January 21st. Crash and burn for Elon. You know something? It's not even, not quite even a month and a half. Yeah, we're talking about some of this stuff. That's right. And we're going to look at Zoom and the other hot stocks. Maybe we'll look at Peloton 2. Okay. So what's going on is this rotation. People are gearing up, selling off their hot tech stocks. It's happening so freaking fast. I mean, it's just fast. I mean, you're talking $50 stocks going to 35 in a heartbeat. You're talking $500, $600 stock going down to the 300s in a heartbeat. This is what's happening. And, when we have sector rotation, it's brutal. It's nasty. It causes investors to question everything they've ever done and everything they've ever known. That is a big deal. So what I want to do is get into a couple of things. We're going to take a look first at how the market did today. Let me make my screen a little bigger so you can see it. I know I didn't put it up yet. I'm going to do it right now. Okay. So bam. All right. Boom. I'm up here in the left-hand corner. So the Dow down 345. It was down double that at one point today, more than double that at one point today. So stocks did rebound off their lows. It is encouraging, but something changed. I'll tell you what that is. Well, I'm going to tell you what that is now. What was happening is investors were buying the dips, and they weren't selling the rips, buying in the down days and selling on the up days. They were buying the down days and holding on. Now, all rallies are excuses to sell. We were actually up this morning out of the gate. Stocks were up. The Dow was up. And the Dow was up over 100 points. And it's like, wow, it's looking like we could have a nice turnaround, a nice day. Didn't last too long because any strength today was whittled away because Jerome Powell, as he likes to call himself, Jay Powell, the Federal Reserve Chairman, he didn't defend. He didn't put up a strong defense of interest rates. He said, hey, maybe we will get some inflation, some temporary transient inflation, and rates will go higher. That's being interpreted by many as a beginning of the Powell / Federal Reserve shift to possibly raising rates. The Fed's been steadfast in saying, we're not raising rates. We can see inflation. We will let inflation rise. We won't raise rates until we see the whites of their eyes, the inflation eyes. And all of a sudden, he's not really talking about keeping rates low and doing something big. And people are concerned because today he had a few moments where he could have addressed the current quantitative easing, the big bond buying, the massive bond buying that the Federal Reserve is doing to keep rates low. What people were hoping to hear today was something called twist. Everybody, come on, baby. No, I'm not going to do that to you. Do the twist. All right. Operation Twist is when the Federal Reserve will sell some of its short-term bonds. Maybe short-term rates could go up a drop, and put that money into long-term bonds, 10-year, 30-year bonds to push long-term rates down. And that would have the ability to push long-term rates down because that's what we're worried about. The 10-year Treasury broke through 1.5% today when Powell said didn't indicate that he's going to do anything to hold the line on long-term interest rates from going higher. But people want him to do that by selling short-term bonds or buying long-term bonds. He's not expanding the balance sheet of the Federal Reserve. He's just changing the composition of the Federal Reserve's balance sheet. And he didn't do that. And that's what people really wanted. And if he didn't do that, maybe they are going to tolerate higher long-term rates. But if you have higher long-term rates, it hurts the highest flying of stocks. But if rates are really thought that they could go a lot higher, it hurts everybody. Remember, folks, it's not so much how high rates go right now. It's how quickly they go high. And it does appear that the Federal Reserve doesn't have the control it had a few months ago over the bond market. It's losing control of the bond market. And that is freaking investors the heck out. Okay. That is what's going on. So these are some of the things that are happening today. You should know about these, because if you don't know about these, you might be tempted to just sell your entire portfolio. You might just be like, oh, you know what? I'm just going to get out. And I always say, what good is an investment plan if you can't stick with it? The odds of you getting out and getting back in are so low that you're probably going to hurt yourself, because over time, the market that's high today will be a low in the future, if history means anything for the market, right? But there's no guarantee that past performance is a promise of future performance, something like that, right? Some kind of disclosure that we have to say. Let's see who else is out there. All right, I appreciate it, folks, that you're sticking with me. We have Asher. Tech stocks have been trading at high levels of PE ratios. Yes, they sure as heck have. Agree 100%. Would that actually be rectified, or is this a new normal? Okay, is this a new normal? That is a great question. I almost said always Asher, because I follow you on Instagram, and you're just such a dapper dresser, by the way. You're gonna have to give me lessons. So thank you for asking, Asher. This is not a new normal. I know people say, oh, we're in the new normal. It's the stock market. It's the COVID. It's the pandemic. Yes, there are always new things popping up. They're called black swans. But this is very normal, that when rates go up and we shift out of a recessionary economy heading into a strong economy, the high flyers get hit. Nothing new about it. And money shifts to the cyclical, economically sensitive stocks like industrial companies. You think of like a Honeywell, a Caterpillar, okay, Southwest Airlines. These are companies that are sensitive to the economy. It goes into energy, into financials, and the money comes out of the high flyers. And that's what's happening now. Now, I think maybe something a little new-ish about it is how fast it happens. What used to take like months to happen happens in a day or two now. And that's really the biggest difference, is how quickly everything moves to change course. So will it rectify the high PE ratios? Well, does the rest of the market catch up to the high PE ratio stocks, or do the high PE ratio stocks go down to get down with the rest of the market? Right? I think it's the latter. That's what happens. Josh is out there. Hi, Mitch. Love the show. Love you, buddy. Thank you so much, Josh. I really appreciate you joining us, being out there. Thank you very much. Coming out there from the internet, YouTube land. We got Asher in LinkedIn, and we have Ron in Facebook. I'm hitting it from everybody. Oh, darn. You know what I was going to do today? I was going to set up my phone by camera number 1. That's camera number 1. That's camera number 2. And camera number 3 is over here. Okay? This is not a dirty tissue on my desk. This is just a paper towel, because I had coffee and I don't want to, I had to wipe it up if I spilled some. I spilled stuff. Okay. I was going to put my iPhone right by camera 1 so I could stream to Instagram at the same time. Darn it. I wish I did that. I have to try that one of these days. James, thank you so much for joining me. Mother, thank you very much, James. It's so nice to see you. James is tuning in for Friday morning, and you're thinking, like, Friday morning, what is he on crack? On crack. No, James is in Australia, in Melbourne, Australia. He's a financial advisor, and we support each other's content. We communicate through, email, direct message, whatever. And I was even on his live stream, and I have to have him on my live stream. But so we know each other, and that's the beauty of LinkedIn. I've made a lot of really good friends here on LinkedIn. It's amazing. Thank you very much. And Filippo is out there. Cash is a position. Yeah, absolutely. Cash is a position, and it's like a very overlooked position as well. Thank you so much, Keith. Good show. Thank you very much. I just have to put Keith out there one more time. Good show, Mitch. Thank you very much. Keith is a financial advisor, the best content creator, by the way, in finance on LinkedIn. So if you don't follow Keith, you should. And here he is. I'm time traveling. I like that. Yes, you are a time traveler. Very cool. So let's get into a couple of quick things. Let's get back, and we're just going to fly through this because I don't want to be on here, forever. Jay Spindell. Jay is out there. Jay, how are you? Folks, if you're watching this, if you give it a thumbs up, I'll actually be able to see your name and see who's out there and say hello. Let me put my picture back in here. All right, I'm back. Okay, here I am. So we have the Dow down. Everything was down. Even gold was down. But you see, oil was up $2.77, up 4.5%. Okay, so good day, and the VIX popped almost to 30. So the VIX, see that the VIX is 28.57. At 30 means there's a real high fever pitch of worry. The 10-year Treasury. We'll just take a quick look at that. Okay. 1.568%, so up 0.098%. That's a pretty sizable up day. And let's take a look at crypto. Crypto is off across the board. Why was crypto off? Because interest rates are going up. And I think crypto, Bitcoin, Ethereum, the whole gang, crypto is like super sensitive, in my opinion, to interest rate moves. If interest rates are going up, it's restrictive for the economy. And I think the thing about Bitcoin is when interest rates are super low and valuations could stretch, the lower PE ratios, the lower interest rates go, the higher PE ratios could go. And even stocks that don't have any earnings, like their valuation, literally mathematically, it could be unlimited as if you do the way the math works in terms of how high they could go. So when interest rates go up, it could maybe slow the economy. When interest rates go up, think of it like a dry sponge in a dish saucer of water, and it soaks up the excess water. When interest rates go up, it soaks up excess dollars, takes dollars out of risk assets and out of the economy, and money maybe moves into fixed income. And when you take dollars out of the economy, then dollars, when that happens, a dollar gets a little bit stronger, and that hurts Bitcoin. So if you want to know why crypto had such a crappy day today, Dow falls more than 300 points as Powell fails to ease rate fears. NASDAQ goes negative for the year. I know what you're thinking, by the way, Ron. Ron's watching. Yeah, I didn't do that trick you told me about the olive oil and the teeth, so you don't go smacking your lips, when you're talking. I just felt weird about olive oil. I like olive oil and some bread and some pasta. That's cool. So here are the energy stocks, whole list of them: Exxon, Chevron. Chevron wasn't the biggest winning stock in the energy patch, but it's been up a lot. Okay, so the energy stocks are the only ones that you can find that are consistently higher today. The FANG stocks weren't too bad, believe it or not. Google had a good day. Facebook up a wee bit. Microsoft is holding up fine. Amazon, you remember what I said yesterday? Apple down, Netflix down. I said Amazon needs to hold 3,000. That was my sense, and it broke 3,000 to 29.76. So it broke it by a good amount. So that's I think concerning, because Amazon has been like that stalwart of the work from home, stay at home stock. So that's definitely a little concerning. Let's keep going. So energy was the only up sector. The bottom ones, technology, of course, discretionary materials, industrials. It was just a really tough day in the street. It's hard to find things to celebrate. If you don't have energy because you just thought it was so bad for so long, you don't have any exposure to it. Well, this is why you hold on to sectors and stocks that aren't performing well. I've said this before about diversification. Keith, you're out there. James, you're out there. Tell me what you think of this. If all of your stocks are up at the same time, you're probably doing something wrong, because diversification, by its very definition, means you'll have up stocks and down stocks, right? Diversification, it's a strategy that we use to minimize risk, but it doesn't necessarily protect your portfolio from a generally down day. today being a perfect example of that. Okay. So we've got a few others out there. Okay. Just want to say, Phil, welcome, my friend Phil. How are you, man? How does it feel to like be living right now in a place with really good, dependable, high-speed internet access? I was thinking you the other day, like, wow, you might have high-speed internet access. Like, what a wonderful thing, right? Just something we might take for granted if we are used to it, right? Asher, I am loving this live stream right now, guys, because of you. Thank you so much for tuning in and hitting me with your questions and stuff. I bought energy, filling up 40% of my portfolio of energy in March, April of 2020. I've been holding and loving it. Oh my God, 40%. Well, that is huge. I mean, you got stones. Congratulations. It was a great move. And you know what? I think I want to get out of the financial advisor world. I want to, Asher, I want to take myself out of financial advisor bubble. Okay. That is great. Not because I'm giving advice that everyone should be 40% oil. No, I'm saying I'm taking myself out of the financial advisor bubble. I'm like contorting myself to get the words right. I think it's great because you can do that. I think it's great because you can do that when you're young, right? Because if energy doesn't turn around from back then, and it was really bad. I mean, oil was negative on the price. It actually went negative. Like if you owned oil, you actually had to pay someone to own oil as opposed to being able to sell the oil. Crazy market. But you could do that because if it doesn't work out, you've got your whole life ahead of you. So I just want to get out of financial advisor bubble and say, oh, that's terrible. You should never have that much money in your portfolio one sector. It's your money. You get to do what you want. Hey, listen, I don't look at my job as to tell you what to do. I'm here to advise, to guide based on your values, your risk tolerance, your time horizon, goals, all those important things. But I'm not here to tell you what you can and cannot do. You're smart. And if you have a way that you believe in that is smart and smarter than what I could recommend, then I'm 100% behind you. Okay. It's good for you. Okay. That was a lot. Thank you, buddy, for chiming in there. They will all then be down at the same time too. Yeah, exactly. So that's right, James. So if you have you got DoorDash, you have Airbnb, you have Zoom, all the other hotties, Amazon, well, they're all down. Look, I know these stocks are huge winners over recent history. I'm just saying on a day-to-day basis like today, though, they all, stocks are all up on Monday. The same ones are all down today, right? Okay. Did I miss anybody out there? Ron always has cool tips for me. Certain throat pastillas like Vocalizone are great for stopping the buildup of bubbles in your saliva from overchewing your words that adversely affect your direction. It's specially formulated to target the symptoms of vocal overuse. It's important to maintain your vocal warm-up routines and remain hydrated as much as possible. I agree, but you know what it is, Ron? It's 4:30 in New York. I've been on the phone like all day long, talking to people all day long, using my vocal cord. So like by the time I get to 4:30, it's a day. It's I've had a pretty full day, but I hear you. I have to maybe keep myself better hydrated. That is a problem for me. I do not keep myself hydrated enough. Keith Scott. All right, Keith, what are you trying to do? Put us all to shame with that picture? I mean, seriously, man. I mean, yeah. I know. You're just like the Adonis of social media, aren't you? All right. Keith is a new connection of mine. He recently joined my networking group, Long Island Elite, and we haven't met in person yet. But exactly means it's not diversified enough. That's right. If everything is up at the same time, exactly. And hey, thanks for putting this together. My pleasure, bro. It's totally my pleasure. I'm here every day at 4:30. Every Monday through Thursday, I do this at 4:30. I'm so happy to put this together for you, and I'm loving that you guys are out there. Corey, does that background light change, Mitch, based on the daily performance? Does the background light change? Yes, it does. Like actually today I could have made it red. So I don't know if you saw my live stream on my setup. This is an accent light with a purple filter. I set it up behind me to give me that purple hue. It's not exactly where I want it, but maybe that's better. No, it's not. It's worse. Okay, so that's an accent light, and I could change it to blue, to red, whatever. And I have one for this camera angle as well. You don't really see it in this angle, but sometimes I like to talk to this angle and give people like an inside view of how I'm doing my live stream. You know, I'm loving this stuff. So yeah, so Keith Scott, this is like the comment of the day. Thank you very much, and thank you, Corey, for checking this out. Corey, if you ever want to talk shop, you let me know. I love what you guys are doing on MCO Advisors, and Keith is out there. A diversified portfolio will have positions that are up and positions that are down at any given time. Absolutely. And I know what Keith is saying. You might be thinking, duh, no kidding. But how many of you are living it? You know, I mean, I have a bunch of friends who we do a Zoom call and we talk shop, and you know, they're not financial advisors, and I guess I'm like definitely the oldest one in the Zoom. And you know, I don't think they're all diversified. I think they're looking for the next Zoom, the next SPAC. By the way, I don't dislike SPACs just because a stock is a SPAC. Okay, so SPACity SPAC. Some SPACs are crackety crack, and some SPACs are whack. Yeah, okay, that's good stuff, man. Oh yeah. Okay, so yeah, so Keith, you are right, and it seems very elementary, but that's true. A lot of people don't actually live it. And Asher, a small portfolio, LMAO. Well, you know what? Your portfolio has gotten bigger, and that's the important thing. But the most important thing about what you're doing, Asher, is the most important thing that you're doing is you're learning, and that's the best thing. You're learning. And if you don't learn, what are you going to do? Try to figure this all out when you're 50 or 60 years old? You're learning. So good for you. That's what it's all about. Good stuff. Thank you very much, Corey. I really appreciate that. It's a small portfolio. I got lucky and I'm riding the rip. I'm glad you're riding the rip. Keith gives me some smiley face, some emojis. Love the tech talk. Thank you, Josh. Thank you. I didn't show your name long enough. Thank you, Josh. And let's hope for green. Yes. You know, I have a green screen actually, so maybe I'll have to just do the whole green background, you know? I know I am showing off. Let's have a round of applause for showing off. So you're having way too much fun. I am, and we got to get to some serious stuff because I have to talk about what to do. Been at the Purple Haze, Mitch. Hey man, you Purple Haze. You think I don't know a good Jimi Hendrix metaphor when I see one, man? Are you kidding me? Of course. Comments are on fire today. I'm telling you, this is a lot of comments for my live stream, and thank you very much, guys. So we've been on for 28 minutes, so let's wrap this up. You could think that, hey, you know what? I'm going to get out of the market altogether. Rates are going higher, or I'm going to get out of tech stocks and wait to get in at a better time, or I'll just rotate everything from tech to, you know, the economy reopening stocks. And you might also think, well, Mitch, if you're so sure that the work from home, stay at home, COVID stocks are going to go lower, why don't you just sell them? I could be as sure as I want, but I'm not a fortune teller. So if I'm sure of something, what makes me sure? I'm not here to gamble. I mean, I could gamble with my money, but not with, you know, someone else's money. So the idea is that if you sell and you want to get back in and the market goes up, you'll be like, well, I could have bought when it was lower. I'm going to wait till it goes lower. And then the market goes lower and you'll be like, well, now it's going lower again, so I'm going to wait. And then it goes lower and you go, wow, if it's going lower, I'm going to wait for it to go even lower. And then it goes up and then you're like, but I could have bought it lower. It just becomes endless procrastination. The name of the game is this. Maybe interest rates keep going up. Maybe they go back down. Maybe Chair Powell of the Federal Reserve will do something to keep interest rates low. Maybe the COVID variants will spread and cause another lockdown. Maybe this, maybe that. You and I don't know. So the real key is to stay diversified and have a portfolio that you could live with, because over time, it's time in the market, not timing the market. And that, my friends, is the bottom line. So I want you to stick with it. And if you have any questions about any of this stuff, you're always welcome to call me. But it sounds like you guys are doing great. Thank you very much. I'm going to end the stream now. Anyone else out there? That's it. Ron is out there. Thanks for tuning in to the live stream, guys, presented by Mitch Goldberg, MD, the Money Doctor. Thank you very much. Filippo, time in the market over timing the market. Absolutely, my friend. And I look forward to seeing you. Did I mess that up? Time in the market over time in the market. What? All right. I just said that. Yes. Oh, I'm glad you said it first. Thank you very much. All right, guys. I will see you on Monday. Thanks so much for joining me. This was a lot of fun. I hope this was as good for you as it was for me. All right. See you Monday. Thank you.